Picture this. You're building a tech giant. But instead of starting in a cramped Silicon Valley garage hacking together a social media app, this unicorn was engineered in boardrooms and highly secure defense hubs. Why? To solve one of the absolute most critical life-or-death bottlenecks in modern warfare. Today, we're diving into the meteoric rise of Lyntris. They're a massive defense technology startup that is completely fundamentally rewiring how the military processes information on the battlefield. Look, to really get why this company is making such huge waves, we first need to understand the terrifying problem they're tackling. Out on the modern battlefield, latency, that delay in processing data, is absolutely lethal. We seriously have to ask ourselves, what happens when your state-of-the-art sensors detect an incoming threat, but they literally cannot talk to the systems meant to neutralize it? This isn't just some theoretical white paper problem. It is the harsh reality of operating across land, sea, air, and space, all at the exact same time. The gap we're facing today is, well, it's massive. On one hand, you have these legacy, fragmented systems. We're talking incredibly capable pieces of military hardware, but they were built for a totally different era, a time when systems operated in their own little isolated bubbles. On the flip side, you have modern multi-domain threats. Today's adversaries, they don't just roll tanks across a border. They move at hypersonic speeds, they jam satellite comms, they launch cyber attacks, and they coordinate across every single domain simultaneously. The legacy approach just simply cannot keep up with that kind of blistering speed. So, let's talk a bit more about this fragmented battle space. For decades, the defense industry basically operated by having different contractors build totally isolated puzzle pieces. Company A builds the radar, Company B builds the software, Company C builds the missile. And the result? You get a highly capable but completely disconnected environment where systems desperately struggle to share data when milliseconds actually matter. It's kind of like trying to get an old-school Mac to share files with a brand-new Windows PC. It's clunky, you need weird adapters, it crashes, and it takes forever. That's frustrating when you're just sharing a spreadsheet, right? Now imagine that exact same software incompatibility, but instead of a spreadsheet, you're dealing with incoming missiles. In a contested environment, fragmented tech doesn't just slow you down, it creates massive, glaring operational vulnerabilities. Which brings us to the big question. What exactly is Lyntris? Enter Lyntris. And this is where the business strategy gets really fascinating. Lyntris isn't some legacy defense contractor that suddenly decided to pivot. No, they are a newly minted defense technology powerhouse, uniquely designed from day one to operate as the connective tissue for the modern military. They realize that the future of defense isn't just about having the biggest weapons anymore. It's about having the most seamlessly connected network. Their entire business thesis revolves around mastering this one fundamental concept, the sense-to-act loop. Basically, they provide a unified, modular technology stack. They create a totally seamless connection between sensing a threat, processing the intelligence to figure out what it is, getting command and control approval, and finally executing the mission. They take a chaotic mess of fragmented data and turn it into coordinated certainty. Let's break down this sense-to-act loop a little further. Because, let's be honest, sense-to-act sounds like perfect corporate buzzword bingo, right? But for Lyntris, it is a very literal, tangible architecture that they are actively installing into hundreds of defense programs right now. They pull this off by actually owning three incredibly complex layers of the tech stack. First up, they build the physical sensor hardware. Think advanced radar, proprietary radio frequency tech, even robotic arms and high-precision gimbals for space satellites. Second, they provide the sensor architecture. This is the embedded software and signal processing that translates raw physical data into something a computer can actually understand. And finally, the data and software platforms. This is the artificial intelligence that fuses all of this data together so human commanders can make those split-second, high-stakes decisions. So here is exactly how a signal moves through these layers at machine speed. Step 1. A Lyntris sensor on, say, a satellite or a ship detects an anomaly. They call this sense. Step 2, that raw data is instantly fed into their AI-driven software platform to identify it, track it, and filter out all the random noise. They call this make sense. Step 3, the system securely transmits targeting coordinates to a defense system to actually neutralize the threat. They call this act. Sense, make sense, act. It's this continuous, lightning-fast loop. Now, let's look at the M&A playbook behind all of this. If you're a startup enthusiast, you are probably sitting there wondering, how does a company just suddenly emerge with the capability to build space satellite components, advanced AI, and radar all at once? Well, the answer shifts our story from the battlefield straight into the boardroom. The mastermind behind this defense unicorn is a private equity firm called Trive Capital. They executed a highly aggressive, thesis-driven, roll-up strategy. Instead of trying to build all this from scratch in a garage, Trive Capital looked at this wildly fragmented defense market and just started buying up highly specialized, best-in-class niche companies. Their goal was literally to buy the puzzle pieces and forcefully integrate them into a single, unified technology stack that could do what no single small startup could ever pull off alone. Let's track this aggressive timeline, because the sheer speed of their execution is honestly stunning. Back in December 2018, Trive acquired Vitesse, giving them world-class hardware manufacturing scale. Fast forward to November 2022, they grabbed Accelint, securing highly advanced AI and mission software capabilities. Then, in May of 2026, they officially smashed these two titans together to form the unified Lyntris brand we know today. And they definitely didn't stop there. Literally just a month later, in June 2026, they swooped in and acquired a Houston-based robotics company called Novium, instantly adding spaceflight-proven motion systems to their portfolio. It is pure strategic acceleration. But here's the thing, you can't just staple a bunch of companies together and expect them to magically work. You need a highly specialized executive team at the helm. Lyntris is led by CEO Brian Morrison. This is a guy who actually served on active duty in the Iraq War, was an assistant general counsel at the CIA, and held top positions at the Department of Defense. He knows the classified mission requirements better than anyone. Then you have President Matthew Alty, a metallurgy expert who knows exactly how to manufacture complex aerospace hardware at a massive scale. And balancing them out is CFO Tim Paulin, an M&A banking veteran who knows exactly how to financially structure and integrate these aggressive tech roll-ups. It's honestly the perfect trifecta: government intelligence, industrial manufacturing, and financial engineering. All of this perfectly sets the stage for a massive debut. All of this rapid integration, this top-tier leadership, and this critical technology pave the way for the climax of this startup's journey. With the defense sector heating up and capital markets absolutely hungry for defense tech assets, Lyntris stepped onto the grand stage of the New York Stock Exchange. And to understand the hype behind their public listing, you just have to look at the sheer scale of their operations. Before they even rang the opening bell on Wall Street, Lyntris had already amassed an absolutely massive backlog of defense contracts. Their systems are currently embedded in over 200 active military programs across the US and allied nations. That kind of recurring, locked-in government revenue, that is a dream scenario for any tech company. Leveraging that massive backlog, they hit the public markets under the incredibly fitting ticker symbol LYNX. They raised a colossal war chest in their IPO, and part of the brilliance of this capital raise is how strategic it was. It allowed them to aggressively pay down the debt they took on to acquire all those smaller companies in the first place, completely freeing up their balance sheet so they can go out and buy even more specialized tech firms. And that brings us to their valuation. Trive Capital's strategic roll-up engineered a company that reached true unicorn status, blowing past $1 billion to become a massive multi-billion-dollar juggernaut. In just a few short years of highly targeted acquisitions and seamless integration, they successfully birthed a full-fledged defense tech unicorn that is fundamentally rewriting how the military scales its data architecture. I think this quote from CEO Brian Morrison really hits the nail on the head. It perfectly encapsulates exactly why this company's journey matters so much. They aren't just out there selling hardware or software, they are selling speed. Because when threats are moving faster and operating across space, air, and cyber all at once, relying on the legacy approach isn't just inefficient, it's incredibly dangerous. The technology absolutely has to match the reality of the threat. Which leaves us looking toward the horizon of defense innovation. As AI accelerates and these defense networks become increasingly autonomous, the ultimate competitive advantage isn't going to be firepower anymore, it's connectivity. So the real question is, as the modern battlespace continues to evolve, who will ultimately win the race to completely eliminate the latency of war? It's an absolutely fascinating space to watch, and Lyntris is sitting right at the epicenter of it. A massive new player is about to test the waters of the New York Stock Exchange. We're looking at the impending public market debut of Lyntris, a defense tech powerhouse listing under the ticker LYNX. Institutional investors and aerospace analysts, they are watching this incredibly closely. It's a highly structured, private equity-backed roll-up aiming to capitalize on a very urgent shift in military modernization. We've got a ton of financial data, transaction mechanics, and market context to unpack. Let's look at exactly what's under the hood of this offering. The sheer scale of this debut, it is honestly staggering. $2.53 billion. That's the targeted valuation cap if they hit the top end of their pricing range. So, looking at the transaction mechanics, here is how it breaks down. Lyntris is offering 24 million shares of common stock to the public, setting an initial pricing range between $19 and $22 a share. If they price at the absolute top of that range, this offering raises up to $528 million in gross proceeds, cementing that massive $2.53 billion market cap. It's a pretty bold valuation for a newly unified entity, but, the capital markets have shown a voracious appetite for this exact type of defense asset lately. But what's truly revealing is the internal architecture of the offering itself. When you break down those 24 million shares hitting the market, there's a really stark division. Roughly 80% of this offering, that's 19.12 million shares, consist of secondary shares. These are being sold by existing stockholders, primarily vehicles tied to the private equity firm Trive Capital. So, to be clear, Lyntris will not see a single dime from the sale of those secondary shares. That is purely a liquidity event for the private equity sponsor. However, the company itself is issuing 4.88 million primary shares. At the midpoint price of $20.50, that yields about $100 million in gross proceeds for Lyntris. Their strategic objective for that capital is highly specific. They're targeting a $60 million paydown of a newly established revolving credit facility managed by Citibank. By extinguishing that high-interest bank debt, they're aiming to significantly deleverage the balance sheet and, frankly, free up capacity for future acquisitions. Now, to justify a multi-billion-dollar valuation, we really have to look at the top-line engine. As of the 12 months ending June 30, 2026, Lyntris recorded a trailing 12-month revenue of $450.84 million. Listen, this is not some speculative startup. This is a business operating with significant mass and scale within the defense industrial base. They're generating nearly $500 million by providing what they call sense-to-act connectivity solutions. Basically, the hardware and software that allow military operators to detect threats and act on them at literal machine speed. But to objectively evaluate this business, we need to dissect the financial reality over time. Look at the momentum here in the first half of 2026 compared to the same period in 2025. Top-line revenue showed an incredibly impressive 34.6% growth, jumping from $179 million to just under $241 million. However, the bottom line? Well, it tells a much more complex story. Despite that aggressive revenue expansion, Lyntris remains unprofitable on a GAAP basis, and those net losses are actually widening. In the first half of 2026, their net loss expanded to $13 million, up from $9.7 million the year prior. For any prospective investor, this dichotomy, surging top-line growth against widening bottom-line losses, that is the central financial puzzle of the Lyntris IPO. So the absolutely crucial point here is understanding the origin of those GAAP losses. Because when we strip out the non-cash and non-recurring items, the underlying operational picture shifts. Adjusted EBITDA actually grew by 28.6% year-over-year in fiscal 2025, reaching $62.6 million. Furthermore, the adjusted EBITDA margin expanded from 14.6% in FY24 to 16.1% in FY25. So you're probably wondering, why the heavy GAAP unprofitability? Well, it stems directly from the private equity playbook. See, Lyntris was officially formed in May 2026 through the combination of two existing Trive Capital portfolio companies, Accelint and Vitesse Systems. What you're seeing on the bottom line are the heavy integration costs, the amortization of intangibles, and the very expensive software and enterprise system implementations required to stitch these previously separate businesses into a single, unified defense prime. And that revenue is generated across a highly diversified connected battle space. In fiscal 2025, their largest revenue engine was maritime domain awareness at $156.7 million, which grew over 26% year over year. That's followed closely by air and missile defense at $135.7 million, and space ISR and resilient communications bringing in $96.6 million. The takeaway here is they aren't reliant on a single experimental technology. The company is actively embedded across more than 200 distinct Department of Defense and allied nation programs. We're talking everything from proprietary radar and antenna subsystems to the AI-driven data fusion software that actually processes the intelligence. But here is the metric that should truly catch the eye of any analyzing their competitive mode: 90%. That is the percentage of their fiscal 2025 revenue derived from sole or single-source contracting positions. In the defense sector, this is literally the holy grail. It means that for 90% of their revenue base, they aren't engaged in constant margin-crushing bidding wars for every new task order. They have successfully embedded their proprietary intellectual property into the foundational architecture of these defense programs. And once you do that, it becomes incredibly difficult and costly for the government to rip you out and replace you with a competitor. Of course, a sole source moat is only valuable if the orders are actually materializing, and, well, they are. Just look at the staggering acceleration in their backlog. As of June 30, 2026, Lyntris reported a backlog of $923.9 million. That is more than double the backlog from the exact same time the prior year. For a company posting $450 million in trailing 12-month revenue, sitting on nearly $1 billion in contracted backlog provides tremendous multi-year revenue visibility. It strongly signals that their core thesis, connecting disparate sensors into a unified action network, is actively being funded by the Pentagon. Now, Lyntris isn't operating in a vacuum, and the timing of this IPO is highly strategic. Since April of 2026, the New York Stock Exchange and the NASDAQ have seen an absolute flurry of defense technology peers testing the public markets. Companies like Arcasys, Avex, Applied Aerospace and Defense, Doncasters, and Hawkeye 360 have all made their public debuts recently. The capital markets are demonstrating a really robust appetite for aerospace and defense assets. We're seeing a clear shift where investors are no longer viewing them as slow-growth legacy industrials, but rather as high-barrier secular growth technology plays. The why behind this sudden sector momentum is pretty stark. As CEO Brian Morrison notes, the legacy approach is basically failing. We're in a period of intense geopolitical volatility right now. Major global conflicts, notably the US-Israeli war on Iran, have fundamentally exposed the vulnerabilities of fragmented military systems. Modern adversaries operate across space, cyber, air, and sea simultaneously. Think about it. If a radar detects a threat, but that data can't instantly communicate with a missile defense system because they were built by different legacy contractors in different decades, you lose the mission. Lyntris is capitalizing on the Pentagon's urgent and well-funded mandate to buy unified, sense-to-act, multi-domain architectures that can process this information at machine speed. However, as analysts, we have to deliver a balanced, objective assessment of the bear case. And for sure, there are critical vulnerabilities here. First up is execution risk. Since 2018, this entity has bulked up through 12 separate acquisitions. Integrating that many disparate corporate cultures, IT systems, and engineering teams is notoriously difficult. Any delay in realizing synergies between their hardware and software divisions will directly threaten their path to profitability. Furthermore, despite that massive backlog, they remain entirely reliant on the U.S. government and shifting congressional budgets. A delayed appropriations bill in Washington can stall their revenue recognition practically overnight. And finally, we just can't ignore the ongoing gap on profitability. Eventually, investors are going to demand positive net income, not just adjusted EBITDA. To their credit, Lyntris has intentionally structured its business to mitigate some of those exact concentration risks. They maintain very strict program exposure limits. In fiscal 2025, no single defense contract accounted for more than 7% of their total revenue. On top of that, roughly 85% of their revenue is domestic U.S. business, while the remaining 15% comes from allied international partners. So, if Congress suddenly cancels one specific missile program, Lyntris is insulated enough that it won't crater the entire company. But then again, that insulation doesn't automatically solve those bottom-line integration pressures we just discussed. Which brings us to the final, suspended question the markets have to decide next week. We have a company with an incredibly defensible moat, again, 90% sole source revenue, riding a massive macroeconomic wave of defense modernization, supported by a backlog approaching $1 billion. But they are asking for a premium $2.5 billion valuation while still navigating the expensive, messy realities of a private equity roll-up that is actively bleeding cash on the bottom line. So what do you think? Does the strategic necessity of their sense-to-act technology outweigh the near-term unprofitability? The way institutional investors answer that question will dictate exactly how Lynx trades when the bell rings on the New York Stock Exchange.